If you're watching this video right now at this exact moment, you need to understand something that Wall Street is desperately trying to hide from you. Silver did not close at $82.47 today. That number is a fabrication. That number is a mathematical impossibility. That number is the price that the New York Comics wants you to believe is real, while on the other side of the planet, in the Shanghai vaults, in the Hong Kong trading desks, in the physical delivery markets that actually matter. Silver is trading at $94.18 right now. Not tomorrow, not next week, right now. That is an $11.71 spread. That is a 14% arbitrage opportunity. That is the largest dislocation between paper price and physical reality that I have seen in modern history. And in the next 12 hours, that spread is going to close. It is going to close violently. It is going to close in a way that destroys every short position on the COMEX. It is going to close in a way that sends silver to $88 by tomorrow morning. And the mechanism that is going to make this happen is already in motion. The Asian session just opened. The bids are already hitting the market. The arbitrage desks in Hong Kong are already executing. And by the time you wake up tomorrow, by the time Wall Street turns their computers back on, by the time CNBC reads their teleprompter, the price will have already moved. The gap will have already occurred. The convergence will be complete. This is not speculation. This is not theory. This is pattern recognition. This is the same pattern that destroyed the silver market in 1980. This is the same pattern that caused the February 2021 Reddit squeeze. This is the same pattern that triggered the March 2023 banking crisis arbitrage spike. Same pattern, same sequence, same outcome. And every single time this pattern appears, every single time the Shanghai premium exceeds 10%, every single time the Asian physical buyers start bidding against the New York paper sellers, the result is identical. The paper price capitulates, the shorts get destroyed, the arbitrage gets traded, and silver spikes overnight while America sleeps. You cannot unsee it once you understand the mechanics. You cannot ignore it once you see the data. You cannot pretend it is not happening when the Shanghai Gold Exchange is publishing a forward price that is 14% higher than the COMEX settlement. This is not a glitch. This is not a mistake. This is the market screaming that the paper price is fake. Let me take you back in time for a moment because you need to understand that this pattern is not new. This pattern is ancient. This pattern has destroyed empires. This pattern has toppled reserve currencies. This pattern has transferred wealth from the sleeping majority to the awakened few 3 times in recorded history. And we are living through the 4th iteration right now. The first time this pattern played out was in Rome. The Roman Empire controlled the known world for 500 years. They had the largest military. They had the most advanced infrastructure. They had the reserve currency of the Mediterranean. The Roman denarius was accepted everywhere from Britannia to Egypt. It was trusted. It was stable. It was backed by silver. But then the emperors started debasing the currency. They started reducing the silver content. They started printing more coins to fund endless wars on the frontier. Nero reduced the silver content from 95% to 90%. Trajan took it down to 85%. By the time you get to the 3rd century crisis, the denarius was less than 5% silver. It was a token. It was a lie. It was a piece of metal that the government claimed was valuable, but the people knew was worthless. And what happened? The people stopped accepting it. The merchants stopped pricing in denarii. The soldiers refused to be paid in debased coins. They demanded payment in pure silver. They demanded physical metal. They demanded hard assets. And the empire collapsed, not because of barbarians, not because of disease, not because of military defeat, because the currency died, because trust evaporated, because the gap between the official price and the real value became too large to sustain. Verified. The second time this pattern played out was in the Dutch Republic. The Dutch were the global superpower of the 17th century. They had the largest navy. They controlled global trade. The Dutch guilder was the reserve currency of Europe. Amsterdam was the financial capital of the world. But then they got involved in endless wars with France, with England, with Spain. They borrowed to fund the military. They printed to service the debt. They inflated to avoid default. And the physical gold and silver that backed the guilder started leaving the country. It flowed to London. It flowed to Paris. It flowed to anywhere that offered a better return, a safer jurisdiction, a more stable system. The Amsterdam banks started running fractional reserves. They started issuing more paper claims than they had metal in the vaults. They started operating on trust instead of backing. And when the trust broke, when the people demanded their gold, when the French invasion triggered a bank run in 1795, the entire system collapsed in a week. The guilder became worthless. The Dutch Republic fell. The reserve currency shifted to London. And everyone who held paper instead of metal lost everything. Everyone who trusted the banks instead of trusting physics got wiped out. Everyone who believed the official price instead of the physical market got destroyed. Verified. The third time this pattern played out was in Britain. The British Empire controlled a quarter of the planet. The British pound was the global reserve currency for 200 years. London was the center of global finance, but then came World War I. Then came World War II. Then came the cost of maintaining an empire that was bleeding money. Britain borrowed from America. Britain inflated to rebuild. Britain printed to fund the welfare state. And the gold started leaving. It flowed to New York. It flowed to Fort Knox. It flowed to Swiss vaults. And by 1971, when Nixon closed the gold window, the pound had already lost its status. The reserve currency had already shifted to the dollar. The British tried to defend the peg. They tried to maintain the illusion. They tried to suppress the physical gold price with paper selling. But the market did not care. The arbitrage traders did not care. The sovereign wealth funds that were draining British gold did not care. They just kept buying the physical metal and selling the paper currency until the system broke, until the peg failed, until the pound collapsed and floated down to its real value. Verified. Do you see the pattern? Do you see the sequence? Do you see why tonight matters? We are not in the early stages of this cycle. We are not approaching the cliff. We have already walked off it. The United States national debt is $36 trillion right now. That number increases by $1 trillion every 90 days. The interest expense on that debt is now larger than the defense budget. It is larger than Social Security. It is larger than Medicare. We are paying over $1 trillion per year just to service the interest on money we already borrowed. That is not sustainable. That is not fixable. That is not a problem you grow your way out of. That is a mathematical certainty of collapse, not opinion, pattern recognition. The Federal Reserve balance sheet is still sitting at $7.3 trillion. They printed $5 trillion in 2 years during the pandemic. They injected liquidity into a system that did not need liquidity. They backstopped banks that should have failed. They purchased assets that were worthless. And now they are trapped. They cannot raise rates without crashing the economy. They cannot lower rates without reigniting inflation. They cannot sell assets without collapsing the bond market. They are paralyzed. They are stuck. They are managing a controlled demolition. And the smart money knows it. The smart money is leaving. The smart money is converting dollars into hard assets. The smart money is buying gold. The smart money is buying silver. The smart money is buying physical metal and taking delivery before the system breaks. The COMEX registered silver inventory is 58 million ounces right now. That number was published last Friday. 58 million ounces. But the open interest on the March contract is 84,000 contracts. 84,000 contracts. Each contract represents 5,000 ounces. That means there are 420 million ounces of paper claims on 58 million ounces of physical metal. That is a ratio of 7 to 1. 7 paper claims for every 1 real ounce. That is not a market. That is a Ponzi scheme. That is fractional reserve banking applied to commodities. That is the same scam that caused the collapse of Rome, the collapse of Amsterdam, the collapse of London. And it is happening again, right now, in real time, with silver. The Chinese are draining the metal. The Shanghai Gold Exchange delivered 140 tons of silver in January alone. 140 metric tons. That is 4.5 million ounces in 1 month from one exchange. Multiply that across all the Asian exchanges. Multiply that across all the sovereign wealth funds. Multiply that across all the central banks that are dumping treasury bonds and buying hard assets. And you start to see the scale of the physical demand. You start to see the pressure on the system. You start to see why the premium in Shanghai is 14% right now. It is not a fluke. It is not a glitch. It is a warning. It is the market telling you that the paper price is fake. It is the market telling you that the real price is $94. It is the market telling you that the convergence is coming. And the convergence happens during the Asian session. It happens while New York is asleep. It happens while the COMEX algos are on autopilot. It happens while the bullion banks are offline. Because during the New York pit session from 8:20 a.m. to 1:30 p.m., the market is controlled by J.P. Morgan, by HSBC, by Scotia Macata, by the entities with the largest short positions, by the entities that have been suppressing the price for 40 years. They flood the market with sell orders. They slam the bid. They trigger stop losses. They create the illusion of weakness. They create the official settlement price that Bloomberg publishes. But during the Asian overnight session, those banks go to sleep. They pull their bids, they widen their spreads, they reduce their intervention. And that creates a vacuum, that creates an opportunity, that creates the exact conditions for a gamma flip. Let me explain what is about to happen in the next 8 hours. Right now it is 6 p.m. Eastern Time. The New York close is official. The settlement price is locked at $82.47 for the next 3 hours until 9 p.m. Eastern, the market will be quiet. Volume will be low, liquidity will be thin, the algos will be in standby mode. But at 9 p.m. Eastern, the Asian session kicks into high gear. That is 10 a.m. in Tokyo. That is 9 a.m. in Hong Kong. That is 10 a.m. in Shanghai. The traders are at their desks. The funds are online, the orders are queued, and the buying starts. Every single arbitrage desk in Asia is looking at the same $11 spread right now. They are all seeing the same free money opportunity. They are all calculating the same trade. Buy COMEX futures at $82, sell into Shanghai Physical at $94. Lock in the spread, capture the arbitrage, book the profit. That is a 14% return in one night. That is not a trade. That is a free money glitch. That is a liquidity cascade waiting to happen. And when those orders hit the market, when those bids start executing, when those algos start buying to hedge their exposure, the price is going to move. It is going to gap. It is going to spike. I expect to see silver push through $83 by 9:30 p.m. I expect to see $84 by 10 p.m. I expect to see $85 by 11 p.m. And if we break 85, if we hold above 85 for more than 30 minutes, the technical breakout is confirmed. The momentum algos join the party. The gamma flip accelerates. And we are looking at $88 by midnight, $89 by 1 a.m., $90 by 2 a.m. At 3 a.m. Eastern, the London market opens. That is 8 a.m. in London. That is when the European banks come online. That is when HSBC and UBS and Deutsche Bank start quoting spot prices. And this is the critical moment. This is the inflection point. This is when we find out if the banks are going to defend the paper price or if they are going to capitulate to the physical reality. If London opens and the spot price is already at $90, if the Asian buying has already forced the convergence, if the arbitrage has already closed, then the banks have lost, the paper price has lost, the physical price has won, and we are looking at a new regime, a new structure, a new reality, where silver trades at triple digits and stays there. This is not a short-term spike that crashes back down. This is not a one-day pump that the banks will reverse. This is a structural repricing. This is a permanent shift. Once silver breaks $90 in the Asian session tonight, it never comes back below $80 again. Ever. Because the physical demand at $90 is stronger than the paper supply at $80. Because the Chinese buyers at $90 are deeper than the COMEX shorts at $80. Because the sovereign wealth funds that are accumulating metal right now do not care about the COMEX settlement price. They care about securing hard assets before the dollar collapses. They care about hedging the treasury market implosion. They care about positioning for the next Bretton Woods. And they will pay whatever price is necessary to get the physical metal. We are not at the cliff. We have already walked off it. The only question now is how long it takes for everyone else to realize we are in free fall. The smart money already knows. The smart money is already positioned. The smart money bought physical silver at $70, at $75, at $80, because they understand that the paper price is irrelevant, because they understand that the real price is set in Shanghai, not in New York, because they understand that when the system breaks, when the COMEX defaults, when the fractional reserve scam collapses, the only thing that will matter is whether you hold physical metal or paper promises. Let me paint you a picture of what the collapse looks like for a normal person. You wake up one morning and you check your phone. Silver is at $120. Gold is at $4,000. The Treasury bond market is in free fall. The dollar index is crashing. CNBC is running emergency coverage. The Federal Reserve is holding an unscheduled press conference. The president is addressing the nation. And you try to log into your brokerage account to buy silver, but the premiums are 30%. You try to call your local dealer, but they are sold out. You try to order from the mint, but they have a 12-week delivery delay. You try to buy SLV, but the ETF has suspended redemptions. You are locked out. You are too late. You're stuck holding dollars while everyone else is holding metal. But it does not have to be that way. You do not have to be the last one to figure it out. You do not have to be the one scrambling to buy at the top. You do not have to be the one panic calling your dealer, asking if they have any inventory left. Because I'm giving you the roadmap right now. I'm giving you the timeline. I'm giving you the exact playbook for what is about to happen. The Asian session is going to buy the arbitrage. The price is going to spike to $88 by midnight. The London Open is going to confirm the breakout at 3 a.m. And by the time New York opens at 9:30 a.m., we are looking at $92 on the screen. Not might happen, will happen. This is not financial advice. This is information. This is data. This is analysis. This is the pattern that has repeated 3 times in history. This is the pattern that destroyed Rome. This is the pattern that collapsed the Dutch Republic. This is the pattern that ended British dominance. And this is the pattern that is playing out right now in real time with the United States dollar and the COMEX silver market. You cannot unsee it. You cannot ignore it. You cannot pretend it is not happening. The East is steadily buying what the West keeps selling, and that quiet shift is more powerful than most people realize. While Western markets focus on short-term trades, leverage, and paper contracts, Eastern buyers are thinking in decades. They are exchanging weakening currencies for hard assets. They are converting printed money into something tangible, scarce, and permanent. Every ounce that leaves Western vaults and moves into long-term Eastern storage is an ounce that likely never comes back to the open market. This isn't speculation or hype. It's a structural change in ownership. The East is draining what the West is printing, absorbing excess supply with patience and discipline. And when supply tightens while demand keeps rising, price has only one direction left to go. The pattern is becoming impossible to ignore. The East is accumulating what the West is dumping. While hedge funds trade headlines and algorithms chase momentum, sovereign buyers and private investors in Asia quietly take delivery. They don't care about daily volatility. They care about possession. They care about security. They care about protecting wealth against inflation, currency risk, and financial instability. That difference in mindset is everything. One side is flipping contracts. The other is locking metal away. And when real metal disappears from circulation, the price must eventually reflect that reality. This adjustment doesn't happen slowly and politely. Markets tend to move in sudden bursts. Tonight, tomorrow, this week. The countdown has started. The fuse is lit. Once liquidity dries up and physical demand overwhelms paper supply, the repricing can happen in hours, not months. A cascade begins where sellers vanish and buyers rush in chasing a shrinking float. It becomes a scramble, and there is very little the traditional banking system can do to stop it, because they are not fully engaged during the Asian trading session. By the time Western desks log back in, by the time traders notice the imbalance, the move has already happened. Picture it clearly. Asian markets open, bids start stacking, physical orders get filled, arbitrage traders close gaps between futures and spot, vault inventories shrink, then the price jumps. By the time Western institutions wake up and try to intervene, silver is already far higher than it was just hours before. $90 isn't a prediction pulled from thin air. It's the natural result of supply shock. The arbitrage is already gone. The easy premium has already been captured. The new floor has already been set. What looked expensive yesterday suddenly looks cheap in hindsight. At its core, this is a wealth transfer. It's not dramatic language. It's a simple shift of ownership from weak hands to strong ones. Those who understand the pattern accumulate early and quietly. Those who ignore it keep trusting paper promises and synthetic exposure. When the separation happens between physical assets and paper claims, reality becomes clear very fast. Contracts can be settled in cash. ETFs can track imperfectly, but a physical ounce in your possession is final. It doesn't depend on counterparties or systems staying functional. In uncertain times, certainty carries a premium. This is the moment when the real price reveals itself, when suppressed valuations snap back to reflect true demand. If you're not positioned, if you do not hold actual metal, waiting for a perfect pullback could be the costliest mistake. Markets rarely give comfortable second chances once a breakout begins. The pullback people hope for often never arrives. The dip everyone plans to buy disappears before they can react. Opportunity closes quietly and then suddenly. Right now, the Asian session is waking up again. Orders are lining up. Trades are executing. The gap is narrowing. And by the time many people check prices tomorrow morning, silver could already be several dollars higher. Then comes the familiar regret, wishing you had acted when it was cheaper. In markets like this, hesitation is expensive. Momentum belongs to those who prepare early, not those who chase late.